Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with a special series on how attorneys are approaching recent SEC accounting guidance as it relates to SPACs. My co-host this afternoon is Eklavya Saraf, global head of SPAC listings at Nasdaq. We are joined by Doug Ellenoff, partner at Ellenoff, Grossman, and Schole, LLP.
Thanks, Jill. Doug, thanks so much for your time, and thanks for joining us for Trade Talks today. The SPAC market's been very strong earlier this year. Given the recent feedback from the SEC, though, on accounting guidance, can you maybe recap the impact on the SPAC sponsors for us, please?
Sure. Hi, Jill. Hi, Eklavya. It's good to see you guys. Can't wait to see you guys in person. The impact has been significant. I think it was by design to be significant, and it has been significant, at least in terms of the disruption that it's caused to the continuing flow of SPAC IPOs, which were nearly 90 in January, February, March, and then you hit April and only warrantless SPACs for the most part have gone forward. And that's largely due to the SEC release by the head of the accounting group, Paul Munter, as it related to warrants being treated as liability from their perspective going forward, which means that all I think it's 700 public companies, whether or not they have de-SPACed or in the middle of de-SPACing or IPOs, need to restate their numbers. It's a significant undertaking for a non-cash charge, which heretofore has never been treated that way. And it's been previewed by the staff. And for some reason, they've reversed their position this time.
Thanks, Doug. And how's the guidance affected the de-SPAC transactions that are currently happening?
You have over 120 business combinations that are pending that cannot go forward unless they reverse their accounting treatment, take a non-cash charge that I mentioned earlier. And so you have a logjam of deals that are held up as a result of this. The footnote editorial I would make is I don't understand how this is good for capital markets and what the investor protection is as a result of this release. I understand that the conversation could be this is the way the accounting rules ought to be interpreted, but it's not that clear cut and it's open to debate.
Right. And now, what was kind of the initial reaction of the SPAC sponsor community? And what do you think is top of mind for the SPAC community since this guidance was implemented?
It's mostly adjectives: aggravation, frustration, but resolve. I don't think there's a single SPAC sponsor that believes this is going to deter them as it relates to their mission to go forward and do a SPAC IPO, because they believe that the prospects for taking private companies public through a SPAC are greater than a traditional IPO and or a direct listing. So it's a short-term problem that will be resolved, and there is no lack of interest in SPAC sponsors trying to find underwriters and move forward with their IPOs.
Thanks. That's a very helpful perspective. And then what steps is Ellenoff, your firm, taking in changing the structure of the SPACs given this recent guidance?
Well, you have a series of SEC releases. To be fair, it's not simply the accounting issue as it relates to the warrant. You have issues as it releases as it related to celebrities, as it relates to admonitions to private companies going public through a SPAC, the projections. So there are a whole series of things that on a daily basis we're taking on board and responding to. Many of the issues that have been raised, like the sponsors 20% promote, is nothing new. It's been true in SPACs for 25 years. It's fully disclosed. But on a daily basis, we're adding risk factors, cleaning up other disclosure that we think that the SEC will require. And we will do what the SEC requires of us, even though we'll also be an outspoken critic when we don't think that what they're asking for is anything other than to delay the program.
And how has your perspective on SPACs changed given the rule changes? And do you have a sense of what we can expect to see from the SPAC market for the rest of the year?
You have to have a macro point of view, which we do and always have, which is there is an inadequate supply of public companies in our capital markets. And there needs to be a mechanism for facilitating private companies to go public. Nothing wrong with an IPO. We're fans of IPOs. Nothing wrong with direct listings for those that can pull them off. But when it comes to the vast majority of companies that are in the private markets held by venture firms and private equity firms, which are probably nearly 10,000 companies as opposed to the less than 4,000 public companies we have that are listed on your exchange and others, there needs to be a new way of getting those private companies public. The SPAC is the preferred approach. It's proven itself very effective over the last couple of years. And so I think once these issues are clarified and the doors open again, you will see an increase of activity, whether or not it'll be equal to the first quarter or more similar to last year. It doesn't really matter to me. It just is confirmation that the SPAC has a place in our capital markets and is doing exactly what it's supposed to do, which is to improve and increase the number of companies in our capital markets.
Thanks, Doug. That perspective is really helpful. And Jill, back to you.
And Doug, before we let you go, just one quick question. Are you working more on SPAC or de-SPAC deals at this point?
More activity on a daily basis having to do with the SPAC acquisitions, but we have multiples of SPAC IPOs that still continue to get processed every day.
All right, Doug. Eklavya, thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Good to see you guys.